our conversation, as we've already started, Abrar, will be about the entire change in the startup world, in the investment world, in the business dynamics, particularly in the initial stage. How are the definitions of unicorns changing? What are the changes that you see in the post-COVID era, in the KPIs, so to say, the variables which judge the success of the startup? So, continuing our conversation, Abrar, you talked about Lyft, you talked about Uber. What are the changes that you're seeing? Do you think a crisis of this scale can make the investors rethink the matrices that they use to judge the success of a company?
Yeah. So I think the short answer is yes, definitely. But let's break that down into some pieces. So let's separate out private equity and later stage investors with earlier stage investors on the venture capital side. In the venture capital side, I think you're going to see a number of things happening right away. So first of all, there is essentially no opportunity to have a public offering. So that avenue is largely closed. So the highest returns, or potentially the highest return, are not really available to any company for the moment. And I think if you take a look at public markets, you're going to see that certainly in the US, this is going to last a while. From a public markets perspective, this downturn is not only significant, it is going to be here with us for some time. So from a macro perspective, that has a very significant effect on the really large exit opportunities. So from that perspective, if you take that off the table, then large-scale M&A or trade sales are really the only avenue that is going to be available for exit. So from that perspective, inevitably, you're going to see a compression of value. The speculative valuations that you saw in many unicorns were based on a potential IPO. And I think those are going to be very speculative. I think a lot of companies are going to be moving away from it. And then there's going to be significant LP pressure that has already started, frankly. And that is going to be for companies that are self-sustaining and have financial strength and cash flow, in some cases, to be able to weather these downturns. So you're going to see an emphasis on companies that actually have revenue, and in some cases that are profitable very quickly. So I think that opportunity is going to hit the private equity world or later stage investors very differently than how it affects early stage investors. I think early stage investors are going to have a very difficult time, and in fact, many of them are going to be forced to just spoon feed their portfolio companies at the moment and just try and get them to essentially have enough runway to get through this for the next, I'd anticipate, at least a year, if not longer.
So, Abrar, some part of that trend we'd already started seeing, particularly after the WeWork episode, and then the Uber episode, and with the public, and then also a lot of companies here, at least in this part of the world, by around September, October, had already started talking about, the investors had started talking about an upcoming recession, right? Nobody knew that it would be in this format. But and companies had already started talking about scale versus profitability in terms of investable companies, late stage and early stage. How much do you see that changing now? What is the proportion of emphasis between profitability and profitability revenue versus scale, both for early as well as late stage?
Yeah. So I think that question, so earlier stage, I actually think that's not the question. I think the question actually is just being able to survive. So the survivability question becomes the more important one for really early stage companies, which do not have the financial strength to keep going without investment. So for them, I think it's just an issue of survivability. Later stage, the emphasis is definitely on profitability. Scale is going to be a very difficult thing to be able to get, unless it's one of the companies I was referring to that could potentially, like for the online sector or some sectors, I think are going to do very well. But for the most part, I think the scale issue is going to be less of a factor to investors than of profitability. What you're seeing, you're right. The downturn was something that a lot of people anticipated, not just because of COVID. It was anticipated, honestly, a year or so ago by most investors. I think what was surprising was how quickly things unraveled. The speed at which the public markets took a downturn was, I think, a surprise to many people. And I think the other thing that was a surprise, certainly in the US, was what the Fed did in terms of unlimited quantitative easing, in terms of zero Fed funds, the zero rate that the Federal Reserve is now at. Those were surprisingly aggressive tactics early on. And what I think most investors are seeing is that this is by no means the bottom of the market. Unfortunately, as the death toll starts rising with the COVID virus, you're going to see it get worse before it gets better. So that is going to be a very big factor for investors, for our investors, for LPs, because they're going to see that, they're going to see the market downturn, and they're not looking at this as necessarily a scaling issue. It's really, are these companies profitable, and therefore do they have a strong survivability that will help them get through this downturn.
So from an LP behavior perspective, I mean, are you seeing a regional difference, or do you think right now everybody globally, it's just human, everybody's performing in a particular pattern?
You know, I think that's a particularly interesting question. So we have a mix of LPs. We have high net worth individuals, we have sovereign funds, with pension funds, and I think what has been interesting is, for the most part, I think LPs are currently better prepared now than they were in 2008. I think many LPs did not have the flexibility, institutional investors, of where to allocate and how quickly they could allocate internally. And I think now they are actually better prepared. I think the other thing that is a good sign is that LPs have the ability to allocate a greater amount to alternatives, and I think that's actually a really good opportunity right now. Public markets are going to be in the doldrums, certainly for the near term, but probably for the medium term also. And so you're looking at institutional LPs see this as an opportunity to rebalance. And I think the smart ones are actually going into more alternatives, because from a opportunity perspective, there are going to be some great opportunities for larger PE funds, mid-market buyout funds, and I think those opportunities are going to they're already here, but I think they're going to be even more opportunities as the economy turns south.
So we're already hearing about companies coming in and trying to rescue a few different size companies. This is also kind of time to buy out distressed assets and assets which would be successful in a normal term.
I disagree with that in the sense that that anticipates that we're close to the bottom, and I don't think we're close to the bottom. Perhaps I'm just being pessimistic about it, but in the long term, that's not going to matter that much. So I guess it depends on what your goals are. Is it to find the best opportunities now. I think from a buyer's perspective, I think there's going to be more of a buyer's market a few months from now. But if you're looking at it as a long-term opportunity to acquire assets, I think, now is a great time, and I think it'll get a little bit better as the year progresses.
So, Abrar, you made a fantastic question in terms of the alternate investments and everything happened very quickly. But I think as people are internalizing the entire situation, of course, alternatives are becoming far more lucrative. So while a lot of people are talking about money drying up for early as well as late stage startups, my sense is that this is the time when people are thinking there's no other, everything is as risky. So, but where do you see the allocation happening when you talk about, from your own experiences and from your LPs, where is the interest? Is it early stage? Is it late stage?
I think it depends. It depends not just on the stage, but on the strategy. So, for instance, our newest fund is an evergreen fund that focuses on dividending out cash flow from portfolio companies. So, we target between 8 to 12% return on that on an annual basis. That type of stable return is seeing a lot more interest now from LPs than it was, say, 2 or 3 years ago. Certainly, when we raised our last fund about 5.5 years ago. So this strategy is something that stable returns, not based on just equity value, but on profitability. I think you're going to see that type of fund do very well. Early stage, even growth stage, I think you're going to find. So early stage, I think it's going to be very difficult for funds to raise capital unless they already have those commitments and a strong LP base. On the growth side, on growth stage private equity funds or later stage VC funds, I think it's going to boil down to the portfolio that they're managing. I think that if their strategy has done well, and to use a phrase, if they're anti-fragile in this environment, and that's not my phrase, that's Nassim Taleb's phrase, but if they're anti-fragile in this environment, I think some portfolios could do very well. As I mentioned, I think online education is going to do very well. I think health-related startups, potentially remote health, I think could do very well in this environment. There are some interesting startups that I think have products and services that could add a lot of value to communities right now. However, the big challenge for them is to have that capital to be able to expand or be able to get the word out in this stage. So I think in growth stage, it's not as easy to see which, if you can't make a broad assessment of the entire growth stage category, I think you really have to pick and choose the winners and by the types of strategies that they've deployed and the portfolio that they have.
So, Abrar, I mean, that's a fantastic point, because a lot of, particularly in the healthcare perspective, you're hearing left, right, and center about investors, funds coming forward and saying, we'll support the healthcare companies, anybody who's pivoting. We had a ventilator producer yesterday who grabbed a massive funding. Do you think, of course, this is the need of the hour. This is something that we all need to do. But is it really a PVC activity right now? Or because...
Yeah, that's a really good question. I think one of the things that you begin to realize is that post-COVID, you're actually looking at a society that is changed forever. There are ways of interaction that are being encouraged now, or are necessary now. that are going to allow people in a broad scale to be able to do things online. So for instance, using education as the example, right now there are more students online, taking their courses online, interacting with other students online than there have ever been, period, certainly in the US. That's very interesting because I think for many students, they never really thought about it as a viable alternative to learning in a classroom. However, now that they're experiencing it and that they can see both the pitfalls and the advantages, I think you're going to see them willing to try certain things in a way that they were unwilling to do so. And I think that's true for healthcare. I think there are certain things that are fundamentally changed. So for instance, there are hospitals that are doing diagnosis over the phone, that are doing consultations over the phone. That was very difficult to do, not because it couldn't be done technologically, but because there was no societal impetus that forced it to happen. And I think that fundamental change in how people interact is going to stay with us. And I think it's going to push consumers who were unwilling to interact in this way online. It's going to change their perceptions, and it's going to allow them to interact and try these opportunities. And that's going to be able to drive down the cost significantly. It may open up opportunities. For instance, I think that in healthcare, the ability to diagnose remotely is going to open up very significant opportunities for companies. And I think India is actually very well positioned for this, potentially. I've seen some startups that look very promising, but the question is, will they have the financial backing to be able to weather some of the ups and downs of the next few months?
So, Abrar, again, a great point. I mean, in terms of timings, the two questions I have, which are interrelated. One is that a lot of people are saying that human memory is short-lived. For this situation to make an impact, it has to last longer. The damage has to last longer. God forbid it does. But we have the propensity to bounce back very quickly. We'll forget about all of this, and Zoom will again become history.
I think. So I have a couple of comments about that. There's a difference between actively thinking about something and creating a habit. Those are two vastly different things. You can create a habit without actually having someone think about it. And what this is doing is it's allowing us enough time to create a habit of being able to do, for instance, this video conference. I've done, just this week, I taught my entire private equity class online over video conference. That was the first time I had done it. And what was interesting is that now I'm much more willing to do it. I have the equipment, I now have an understanding of the issues, and I'm habituated to the opportunity. And I don't think creating a habit is that difficult, especially if it saves you time and money. And I think that's what this is proving. Now, are we going to forget that of the risks involved in this type of thing? Yes, absolutely. We forget market risk very quickly. And so I do agree with that. But I think creating a habit or predisposing you to use certain things, once that initial barrier is crossed, I think it's actually going to be much easier for people to interact and use these types of services.
So my leading question to that is, what are the areas that you think will stick with us, and what would be the measures of success post COVID for both early, so let's talk about early stage first, and the late stage companies.
So early stage, I think a couple of things. So for instance, You saw over the past few years a bunch of logistics companies, Lyft and Uber being just sort of the tip of the spear, but you saw scooter rental companies like Bird, certainly in the US, doing very, very well. I think that's going to be extremely difficult to do. You saw WeWork crash and burn even before this, but you're going to see these types of companies that are basically taking a very traditional industry and trying to move it into the internet age. But they have this they're not online. They do some of it online, but they are in fact physically located in the real world. Those companies, I think, are going to have a very difficult time, certainly in the short term, but I actually think fundamentally in the long term. As companies like mine, we've been working remotely because our offices are so disparate, but most companies don't have this habit of working remotely. But I think now they're starting to see, wait, we can not only remotely work and have our employees work from home, but we save a significant amount of money doing so. So I think those types of companies that are trying to automate or bring online traditional industries, I think are going to have a harder time. On the other hand, I think companies that are doing things online are actually going to be doing very well. So education, healthcare, I think are going to do very well. This is perhaps a little tangential, but I think we're having much more social interaction online. So I think that companies that are trying to create that social interaction online for their products are going to do well. Now, let me unwrap that for a moment. One of the things that I've been watching, and I have not invested in for a long time, but one of the industries that I've been watching very closely has been cryptocurrency. And I think you see a lot of let's say, economists and old world investors poo-poo the industry. But what's interesting is that the current political situation has left a giant vacuum. There is a deep lack of leadership, not only in the US, but globally. And what you're seeing is that there's a lack of confidence that has enervated the political and financial space. In that situation, I think what you're going to see is, I actually think there are really interesting opportunities for cryptocurrency and the things associated with cryptocurrencies, exchanges and so forth. But there is a flight to quality. I think initially you're going to see a significant downturn, just like you see a downturn in everything else. But what people are going to start doing, I think, more so now, cryptocurrency has been more used as a store of value than anything transactional. It hasn't been significantly used as an exchange medium. You're going to see more of that, I think, as this gets, as the world starts doing more online. But also, there's a vacuum, both politically and financially, globally. And so I think there's some opportunities there. Although I've been watching it for some time, I think that's an industry that may see some very significant volatility initially, but I think will long-term grow. Anything transport related, I think, is going to be difficult. But on the flip side, I actually think that now is a very good time to look at some of these green investments, both in energy production and some of the electronics around it. I think that's very interesting. I actually think fintech is going to do very well in this environment after the initial shock. I actually think that not only are people going to be doing things online, I think banking is not only, it was trending in this way for quite some time, but I think you're going to see some really interesting opportunities in the fintech sector, not only in banking, but in insurance tech, there's going to be some very significant shakeups in the insurance industry. And I think you're going to see some very interesting opportunities there. That's a few. I actually have a list of some of the things. Let me see if I can pull it up while you ask me your next question.
My next question is about, so I mean, you talked about transport, you talked about cryptocurrency, fintech and all. There is currently, the other thing that's happening currently from an online perspective is that there is an absolute overload of content, whether it's news, whether it is user-generated content, and everybody's trying to, get there and trying to, the OTT models. What do you think will happen from a media perspective, from an industry perspective, monetizing the content? Who will be able to do it, and is there opportunity there?
So that's an excellent question. I think, I think there's my answer. So we've looked at this space. So first of all, let me say that I am not I'm not an expert in this space. I think the best, but there are a couple of things that, as an observer, I've seen. Content itself is almost irrelevant if no one is discussing it. If there's only consumption but no discussion, then content becomes less meaningful. So I think the key factor is not just having that content, but having people interact around that content. So the media companies that have done a good job at that have partnered or tried to create their own sort of virtual spaces, but have used social media to create some of that interaction. So I think the big media companies are getting better at it. The challenge, though, is that there is a overload of information. And so I think media companies, if they are able to tap into this market, have to do it by creating that interaction, but are going to are going to be challenged deeply by a lot of by things like some of the sensationalist press and some of the sensationalist clickbait that you see. It's going to be hard to compete in that space. That's a tough space. We've looked at it. We've actually been very reluctant to invest into that space just because of the difficulty and the barrier to entry that a lot of these large platforms like Instagram, Facebook, and Snapchat present for being able to roll these out effectively. So yeah, I don't know if that answers your question, but
you had a list you were talking about.
Yeah.
You see that.
Yeah. Go ahead. And I'm just pulling through. Okay. So high exposure. So here are some industries that we think are going to have high exposure to globally to this virus. So apparel, high exposure, automotive manufacturers, automotive suppliers, consumer durables, all going to have very high exposure. Gaming is going to have very high exposure in a positive way. Lodging and leisure, of course, airlines, retail, non-food retail, and just global shipping. We think that those are all going to be deeply affected, largely negatively, but in some instances, especially online gaming, is going to be very positively affected. Industries that we think are essentially not going to be affected or have not going to be significantly impacted. Construction, defense, equipment, transportation, largely pharmaceuticals, rental, food and retail, we think are going to do fine. Telecom is going to do very well. Now, one of the things that is quite interesting is that we think that office space is going to see a big hit. I think the REITs, although a lot of people say that they're not that exposed, we think that commercial real estate is going to be heavily impacted by this. Media, we don't think there's going to be that much. It's going to have moderate impact on media, but not as much as some of the high exposure ones that we were talking about. So I think those were the big ones. Agriculture is an interesting one. I think it's going to go through some significant changes. It was already trying to incorporate a lot of new technologies. We think that that's going to continue, but just moderately impacted, not deeply impacted like some of the other ones that we're talking about.
So Abrar, my next question, I think we're kind of coming to the end before we start taking audience questions. Do you think that this is the time to go to market for either growth stage companies, or there are a lot of companies who want to take up the opportunity? There's an opportunity coming up now with the online content sharing, etc. Do you think this is the time to go to market, or you just wave it out, wait till the right time, and then survive it, and then ask for money?
For the vast majority of companies, I think it's the latter. I think for most companies, they're going to find the fundraising environment very difficult. And I think most companies are going to be better off just trying to focus on trying to get as much profitability out of current operations as possible. That may not be an option for some companies. And I think that what you're going to see is, especially early stage companies, may want to take a look at some of the debt opportunities that are going to come along. So there are a number of initiatives that the federal government is doing here in the US, and I anticipate many countries will go through the same sort of scenario where their governments try to prop up some smaller companies by offering cheap debt. And so I think those opportunities might be there. However, I think the best thing is to wait it out. However, there might be exceptions in certain industries. So for instance, the ones that we were talking about earlier, I actually think there could be some really good opportunities for growth because of that push into online interaction.
Perfect. So, and the last question to that effect is, you talked about, how the global, and you see that trend across the board. But do you see a change in the investment patterns globally? Do you, particularly from a country perspective, do you see money shifting from a particular region to the other, or is it just going to be a localized setting again?
Yeah. So. When markets drop, everyone follows. When markets grow, generally it's not unified. It's a bit haphazard. I think you're going to see a few things that are here to stay. First, I think that the China-US and China global supply chain in manufacturing is irrevocably damaged. I don't think that it will ever, certainly not in the near future, come to what it used to be just a few years ago. So I actually think that there are lots of opportunities because of that. I actually think that India is very well poised to take advantage of that opportunity. I think that I think India is going to get some interest from outside investors, from foreign sources of capital. I think that Southeast Asia will also get a lot of interest. I think overall that is where there's still a lot of growth. There's no question that these economies are growing faster than other parts of the world. So I think that is going to stay, and I think it's going to supersede China as a destination for foreign investment, for foreign direct investment. I think the U.S. is still going to garner a lot of, I mean, the U.S. economy is still quite strong, even though there is a downturn and a recession. I think that the U.S. will continue to be a target. Fundamentally, the opportunities themselves, I don't think are that different. I think that the opportunities in the U.S. are very good. You'll get better deals, you get better valuation, and so I think that's the same in India. I think Europe is going to see a more significant downturn, I think, than the U.S. Although in our London office, we are very closely monitoring the impact of Brexit, for instance. And so we see a long-term, certainly there are going to be companies that do well, no question. But I think long-term, I think that Europe, not because of COVID, but because of Brexit and because of all the other things that have happened during the past few years, I think Europe is, at least for us, not as significant as target as it used to be. But overall, those patterns, I think the biggest pattern is not as much in China. That's probably the most lasting change, I would say.
Maybe Trump is getting successful in creating a narrative, huh?
It's very interesting. We try hard to stay apolitical, but what has been hard to ignore is politics has played a role in how American investors are perceived, and that is honestly, that's a bit unfortunate, because there's a wide disparity in the types of funds and individuals that are here. The market is very deep, and you see all kinds. But I think GPs and fund managers look for opportunity, and I think American GPs are going to be looking very closely at Asia, and I don't think that's going to change. Ex-China, I don't think that the rest of Asia target is going to change that much. Certainly in the VC space, we see lots of opportunities in earlier stage and growth stage investments. And I think that valuations are going to come down. It's going to be a buyer's market. So I think that's great.
Great. Perfect. So we have some questions coming in, Abrar.
Sure.
Let me just take the first one here. And
Sure.
It's random order. We will take all the questions.
No problem.
We have an anonymous attendee asking, for early stage startups, how should they go about market sizing since the consumer behavior is about to change significantly?
That's a very good question. I don't think that we have enough data to be able to predict what these changes are in the long term. Certainly there is going to be change. So I would say that start conservatively and build your model, your financial model, to show profitability, or your focus on profitability, as quickly as possible. I don't think we have enough time or understanding of these changes to be able to say one way or another how it's going to affect consumer behavior. Other than vague generalities of the type that I've told you about, that I think there is a more there's a propensity now and willingness now to do things online. The other thing I would say is try and find a way to piggyback on community building and see how that has scaled. Take a look at how certain products have done when they've integrated chat functionality or interaction, and see how they've scaled. And I think that will be a good model, because if you take a look at products or services, as soon as they add a chat functionality, a the ability for users to interact, typically the usage and the time spent on using the service increases in many cases exponentially. That's the easiest one to model. That's what I would look at. And aside from that, it's going to be hard to know exactly what's going to come out. Ask me 6 months from now, or better yet, a year from now, and then we'll see what long-term effects this has had.
Great. So another question coming in from Sahil. Sahil asks, can the world really survive with these offline stores, considering that the offline is going to face a massive problem? And he further asks, how much downside are we seeing from here before the bottom?
Oof. Okay, let me answer the second question first. So I was alluding to this, but we have not, certainly in the US, we have not seen the bottom. And what the Federal Reserve has already done a lot of stimulus. The Congress has already done quite a significant amount of stimulus. And we're nowhere near the peak. I think this is going to get worse because when people start seeing, unfortunately, the death rate increase, the amount of infections, that is going to really hit hard. And so what the biggest problem is that when the US has a downturn, generally it affects the entire world. So when US markets fall, that is going to be a very significant headwind for other markets. So I think that's not going to happen we're probably not going to see the bottom of this until sometime in the summer. Certainly it's going to be at least a month or so, but it's going to keep coming up. And so it's going to have a long tail. So I think that sometime in the next 2-3 months, maybe we'll see hopefully the bottom. But all of this, some of these short market rallies that you're seeing, those are all engineered. Those are all a reflection of the stimulus that is being generally injected into the economy by the federal government, and they're not here to stay. So so with that, the first part of the question, what was the first part of the question?
The thing that can the world really survive with the less offline, and considering that?
I think it has to. I think if you look back historically, in the US at least, there was an inflection point when we started to buy online, and that was when people started to see that they could buy airline tickets online. That process did a few things. First, it gave you a lot more transparency in what types of flights, when, all of the details of the flights, and that, along with the lower fare, basically changed the way that we travel by air. And that was an inflection point because it allowed us to do something online. It was really the first time most people actually bought something, certainly in the US, online. I think, and after that, we haven't looked back. Online commerce has increased, and in every year since then. I think we're at that same inflection point. People are going to be much more willing to have groceries delivered, to have to shop online. Certain things I think are still going to be difficult. Fashion, for instance, it's going to be hard to do that online, but I think people are certainly going to try. But it's going to be disparate. I think we have come to a point of no return. I think certain brick and mortar stores are going to be hit, and they may never recover. Make no mistake, this is an inflection point in how the world behaves, and I think that's going to have deep repercussions for our traditional businesses. And I think that's going to be true in the US, it's going to be true in China, India, and sub-Saharan Africa. And in some places, they've actually, I would argue that places in the emerging markets have been more willing to do things online than in the US or some other developed countries. So
Abrar, Dr. Ashwini asks from Prozo, he says, I mean, of course, you talked about, the downward concerns of the low consumer sentiment. He says, isn't this a better time to build a company if startups are well capitalized? Why do you think VC money is going to dry up? What's your view?
So the short answer is yes. I do believe if it's well capitalized, I think it's a great time to grow a business. Not only is there going to be less competition, you'll be able to hire more people, better people. I think overall, if you have capital, great. I think you're going to be able to do very well in this environment. Now, the second part, why won't VCs invest? Well, because VCs, like me, are in many ways lemmings. We follow what other VCs follow, for better or worse. And even if we don't, we're deeply influenced, because that's going to it's going to reflect on our portfolios. So if we see that there's been a significant downturn in the market, we are going to value our portfolio less to reflect that. We're going to be more conservative and try and spoon feed some of the companies that we already have in our portfolio so they don't die. We're going to be very careful and take less risk. You're right, absolutely. This is in many ways the best time to invest. But I actually don't think right now is the best time. I actually think a few months from now is going to be the best time to invest. The question is, will you have capital to invest? And that's just as true for investors as it is for portfolio companies. So if you have capital, yeah, this is going to be a great time to build a company, to find opportunities. But if you don't, it's going to be a very tough time to raise capital. And LPs, our investors, our LPs are going to be just as hesitant. And so there's a follow-on effect that goes right through the industry.
So, Abrar, I have two last questions for you. I think more coming in now. But in the energy space, what do you think the fate of oil and gas sector would be after the oil production understalled? So largely about the oil and gas sector. What do you think?
Sure, I think so. From a macro perspective, the oil and gas sector, certainly in our analysis, has basically been in this slow decline. Not only because of transportation, but just because of efficiency's sake. Now, what we see, what COVID has done, what COVID-19 has done, is basically taken off a very significant demand. So in the U.S., you're seeing gas prices, or petrol prices here, that we haven't seen for years. But yet no one is driving. So I think this is going to be a very difficult blow for the oil and gas industry. But it's going to obviously hit different people differently. The companies, the fracking companies in the US, which don't have as cheap production costs, as low production costs as for instance, the Saudis do, are going to not be able to pump oil at all. Saudi, I think, is well positioned in the short term, but I think it's long term. I think it's questionable how the industry is going to do. Certainly, I think overall, long term, the industry is not going to be as profitable, as big as it used to be. So we're a big believer, by the way, in alternative energy. we're looking at many companies that are in the alternative energy space, and everything from the hardware to the services to the financing. So we think that's an opportunity.
Excellent. Abrar, we have the last question for the day. I know we've kind of overshot the time.
No worries.
Alok says, thank you, Mr. Hussain, very insightful indeed. What do you see happening to the packaged consumer goods industry? We're in the alcoholic beverages space. Do you see any impact in this space?
I think for the alcoholic beverage industry, I think it's actually going to be a wonderful time. In the Bay Area, I'll tell you some empirical evidence here. In the Bay Area, in the San Francisco Bay Area, there has been a 50% increase in alcohol consumption in the last week and a half, I think 2 weeks. So there has been a huge short-term surge. Long-term, I don't know how long this will last, but I think the longer that people are confined to their homes, I think that you're going to see a significant increase in alcohol consumption. Will it stay? I don't know. I think at some point it'll level off. I think what is interesting is that for new brands, I think there's a potential opportunity to gain market share, and then whether that would be sustainable, that's a question. I think when things come back to some semblance of normalcy, I think you'll probably see that demand come back to pre-COVID norms. But I think in the interim, you're going to see a significant increase if you haven't already.
We're actually seeing a lot of states terming it as essential services. I don't know.
Oh, certainly here it was deemed as essential service, and liquor stores are open, as are the pot dispensaries here in California.
So we'll take the very last question, audiences, please. Abhishek asks, in healthcare, telemedicine is surely having promising position. For early startups which do not have hard assets on balance sheet, how do you see return on funding models like venture debt to reduce the risk exposure of funds?
That's a very good question. I think the venture debt space is here to stay. And I think you're going to see a significant amount of expansion in that space. Certainly in the US, you're seeing that. So I think having debt on the balance sheet for startups, if they can get it, it's probably a good idea right now. I think that unfortunately, I only know the US market in this space. So I actually think that it's a good idea. I think that the rates themselves are going to be probably going to trend lower, although not that much. It will probably be a little bit more difficult to get venture debt based on the lack of funding from the equity side. So venture debt typically piggybacks on the equity funding. And so if there's a dry up of the equity funding, then venture debt potentially could also see a downturn. For companies that are already funded, I think it's worthwhile to go that route. However, for companies that do not have significant equity funding, venture debt, I think, may not really be a viable alternative. And I don't think that's going to change in the short term. I think the other thing that might be interesting is crowdfunding. I think crowdfunding, we're seeing some interesting moves in crowdfunding, especially in the early stage. So it's still a bit early to tell, but I think that there might be some opportunities on that side too.
Abrar, thank you so much. What a wonderful conversation. And
my pleasure.
And thank you on behalf of all the participants. Thank you very much for being with us today.